Hello traders, welcome back to another episode T4 Trader. By the end of this video, you will learn one the best and powerful scalping trading strategy using HeikinAshi candlesticks and 3 exponential moving averages. Make sure to watch this video carefully until the end so that you don't miss any important details. This trading method is suitable for both beginners and professionals. Before I break down everything you need to know about this trading strategy, if you are new on the channel, please subscribe to the channel, hit the like button, and also hit the notification bell. Exponential moving average is one of the most popular technical indicators used by many traders worldwide. Just like any other type of moving averages, the exponential moving average is also a lagging indicator, which means that it relies on past prices to predict the direction of future prices. So instead of buying and selling anywhere on the regular candlestick chart, we are going to use the HeikinAshi that will give you an extra reliable condition. HeikinAshi candlestick chart allows you to stay with the overall trend by allowing you to avoid the noise or the minor fluctuations of price that is prevalent in a standard candlestick chart. The general idea behind the HeikinAshi bars is that they smooth the price action. As a result, much of the noise shown in traditional Japanese candlesticks is eliminated with HeikinAshi charting. Now let's compare the price chart using a regular candlestick chart and a HeikinAshi chart. On the left side you see a chart composed of traditional candlestick chart. On the right side we have a chart made up of HeikinAshi candles. The charts look pretty similar, however, the HeikinAshi chart is smoother. Referring to the colored circles on the chart, you see the main differences between the two charts. Notice that the HeikinAshi chart isolates some of the noisy price action. As a result, many traders prefer to use the HeikinAshi candles in order to isolate the noise on the chart, which can provide for a clearer analysis of the price action. In this trading strategy we are going to use the HeikinAshi chart to catch longer and persistent trends, by following the trend direction as indicated by the colors of the candlesticks. Then using a HeikinAshi chart will help you toward that end. Trend detection is one of the main functions of this type of charting style. The HeikinAshi trading style puts an emphasis on persistent trends. Small corrections and consolidations are left behind and they are barely visible on the chart. You will notice that when the direction changes on a HeikinAshi chart, the price most likely starts a new move. This helps to distinguish between the potential beginning and the end of a currency pair trend. Since chart noise is filtered, you basically see the naked trend. Using a trailing stop is a good trade management tool to pursue in a trending market. As a result, many traders combine the smoothing benefits of the HeikinAshi chart with a trailing stop indicator to get the most out of a trending market condition. Another way to use a HeikinAshi chart is to look for chart patterns and apply price action rules. In most cases this works the same way as with traditional Japanese candlesticks. But you will find that HeikinAshi chart pattern breakouts are sometimes more reliable than traditional candlesticks charts. How to identify trends on HeikinAshi chart? As we have pointed out, the ease of trend identification is one of the major benefits of using a HeikinAshi chart. With a HeikinAshi chart, you can confidently distinguish strong trends from unsustainable price action. Let's take a look at some examples of trends, both bullish and bearish, using the HeikinAshi chart. Bullish HeikinAshi trend. To identify an uptrend market, at first glance, the bullish HeikinAshi trend looks like a normal Japanese candlestick trend. However, you will notice that the HeikinAshi trend is built primarily by bullish candles and is absent of lower candle wicks. When the price is shooting up, the price action creates very little to no lower shadows. Here on the you can see the strong bullish trend or uptrend market. Notice that there are only a few lower candle wicks on the way up. This means that this bullish trend is very strong. Bearish HeikinAshi trend. To identify a downtrend market, the bearish HeikinAshi trend has the same functions as the bullish one, but in the opposite direction. This means that it is built mainly by bearish candles. Also, a strong bearish trend on the HeikinAshi chart has very little to no upper candle shadows. This is how you can easily identify trends on HeikinAshi chart. That being said, let's jump to our indicator, the moving average. In this trading strategy, we will use a moving average crossover strategy that will use 3 different exponential moving averages with different periods to identify signals on the chart. For this strategy, we are going to use 3 exponential moving averages, but why using 3 moving averages for a strategy? Well, by using 3 moving averages at once, you will be able to see the current direction of price on the chart as well as determine stop losses, trailing stops, and profit targets for further safety. The main benefit of using this strategy is that it can show whether the shorter-term trend is going in a favorable direction. The shorter-term trend can confirm the longer-term moving average and show a divergence. From the shorter trend, we can also determine if we will be taking a trade that follows the trend or counter it. The biggest difference if you use 2 or 3 moving averages is that the strategy with 3 moving averages will have a longer-term trend direction. However, keep in mind that because of the lagging disposition of moving averages, the indicator won't be able to pick tops and be able to see the difference. The indicator won't be able to pick tops and bottoms quite accurately. That's why one thing to keep in mind is that in ranging markets, this scalping strategy won't perform well because it can give you many false trading signals. In this scalping trading strategy, we are going to use the 3 following exponential moving averages: 55-period exponential moving average, the longer-term trend direction indicator, 21-period exponential moving average, the medium-term trend indicator, the 9-period exponential moving average, which acts as the shorter-term trend indicator. If the 9 exponential moving average line crosses over the 21 exponential moving average line, but still above the 55 exponential moving average, that means it is an uptrend and a good long or buy opportunity. Meanwhile, if it crosses below 21 exponential moving average and 55 exponential moving average, then it is a downtrend and a good short or sell opportunity. The 21-period exponential moving average is considered the medium-term trend indicator. So what we would want to see is when the 21 line is below the 9 and above the 55 for an uptrend. The 55-period exponential moving average, which represents the longer-term trend direction. If the 55 exponential moving average is below both the 9 and 21 exponential moving averages, the trend is going upwards. In contrast, if the indicator is above both of the shorter-term moving averages, then we can see that the trend is going downward. By rules. Step number 1. On the chart, pay attention to the highest swing high of the range because it needs to be broken to consider opening a long or buy position. Step number 2. The 9 exponential moving average must cross above the 55 exponential moving average. Step number 3. Wait for 21 exponential moving averages to cross above also the 55 exponential moving average. That means the 9 and the 21 exponential moving averages must cross and be above the 55 exponential moving average. Step number 4. Over. Before buying, watch for the previous swing high on the left side. We should only buy from the close of the candlestick that breaks the previous swing high. Sell rules. Step number 1. On the chart, pay attention to the lowest swing low of the range because it needs to be broken to consider opening a short or sell position. Step number 2. The 9 exponential moving average must cross below the 55 exponential moving average. Step number 3. Wait for 21 exponential moving averages to cross below also the 55 exponential moving average. That means The 9 and the 21 exponential moving averages must cross and be below the 55. Exponential moving average. Step number 4. Sell at the close of the candlestick. Following the moving average crossover. Before selling, watch for the previous swing low on the left side. We should only sell from the close of the candlestick. That breaks the previous swing high. Take profit and stop loss. There are many ways of placing your stop loss in this strategy. What needs to be considered is that you must allow room for the price to move, so don't place it exactly on the line, but also don't put it too far away either. You can use previous swing low or high as your reference to place your stop loss. As for the sell trade, you can place your stop loss at a few pips above the high of the entry candlestick. And as for the buy trade, you can place your stop loss at a few pips below the low of the entry candlestick. Now when it comes to take profit, you must be very consistent. You can use previous swing low or high as your profit targets. Another option is not to place a fixed profit target but use a trailing stop behind each lower swing highs or lows when the price moves in your favor. This way you can get maximum profits until you get stopped out. Trailing stops will also enable you to lock in profits in case of sudden reversal that may take out your profits immediately. Thanks for watching. In case you have any questions, don't hesitate to ask in the comments. Please don't forget to like the video and subscribe to the channel. I'll catch you in the next video.